Good morning, friends. Welcome to MK Investment Managers Media Convergence.
Be a
I
bit
thank you.
loud, Amit. Be a bit loud.
Yeah. So, welcome everyone. Welcome to MK Investment Managers Media Convergence. We'll start in another couple of minutes as we have some few more people joining in. And today we have our Chief Investment Officer, Manish Sonthalia. Uh, the markets have given good numbers for the last quarter, and there are fund managers who know things ahead of time. Manish sir is one of them. 3 decades of experience in the markets, and now he's back with things ahead of time again, I think, with small and mid caps. So our today's discussion would be around small and mid caps and our upcoming PMS and AIF offering, which we would be launching soon. So over to Manish, sir. We can start in the next 1 minute or so.
Sure. Okay, so we start. A warm welcome, ladies and gentlemen. Thanks for sparing your time to be on this webinar. There has been a lot of volatility in the Indian markets. Uh, Post September 24, we saw the markets really correct significantly, particularly the broader markets, the mid and the small cap segment, in the second half of the financial year 25. And deep cuts were there. I mean, the broader markets fell between 30 and 80%. Some of the stocks even fell 80%. So that being the backdrop, and then market has seen a recovery between, let's say, April 24 till June. So where are we currently, and why we are talking about launching a mid cap and a small cap fund at this given point in time? And the simple answer to this is basically, and let me just give you a brief synopsis of why we are launching this fund. We think that, this broader market, always behaves when the entire market somewhat has a negative view about this whole space in general. Uh, Last anecdote of what we saw was during the pandemic, a whole lot of negativity, and the small and mid cap index actually gave one of the best returns. The space entirely gave best returns. Even now, when you have seen some stupendous returns being made between, let's say, 2020 and 25, now the narrative is that, there's a lot of froth in this space. I mean, we will beg to differ out here, and we'll deal with the reasons why we are saying like this. And that is the best time when there's so much of pessimism around this space, the mid and the small cap space. We think it's the best time to launch a fund. It's no point launching a fund when there's a whole lot of gung-ho approach towards this whole space. You will be basically ending up buying quite a bit expensive in these sort of markets. But what better time to buy when there's a lot of negativity around this space? Because we have seen times immemorial when there's blood on the street, you get the best bargains. And that is why we have decided to launch both the PMS and the AF version in this space. It's going to be a diversified, it's not thematic, it's a totally diversified portfolio that we'll have. Concentrated portfolio around 35 odd stocks and across sectors. It's not that we are choosing some particular sectors around this. So I thought it would be a good time to basically run you through a small presentation, a brief analysis of why we think this is the best time to launch a mid cap and a small cap fund. And then basically we'll be taking questions from your side. Any questions would be welcome. So I think the mid and the small cap space is the continuation of the $5 trillion mark that we are approaching soon, and 2030, 31, we should broadly be closer to around $7, $8 trillion. And in that backdrop, I think when each individual states are looking forward to in excess of $1 trillion in the next 5, 6 years, there's going to be a massive broad basing of the growth story of India beyond the large cap space. Every sector would have a right to win. Every genre will have a right to win. The large cap will have their own place. The mid and the small cap will also have their own space. So I think the universe gets bigger in the India's participation in the accelerating growth story of India. And I think it is going to be centered around all the three pillars of the economy, whether it be consumption, whether it be savings, and whether it be investments. And why are we talking about launching this fund now? I think the macros couldn't have been much better at this given point in time. Macros for India are very, very conducive. And I think on a bottom up basis, since there has been a lot of froth that has already been taken out, we think that there is valuation comfort in individual names. You have to do and pick and choose, but still there is comfort in individual names. Why MK Mid and Small Cap Fund? I think over the last 13 years, we have demonstrated on a superior stock picking approach. Most of our funds have delivered good returns for our investors. We follow a proprietary corporate governance evaluation model for the companies that we pick. And this has also stood the test of time. So we have a good track record, and we have collectively more than 100 years of fund management experience under us. So in terms of the macros, I think interest rates are declining. This week, currently, we have another 25 basis point cut, if not more, maybe a 50 basis point cut again. And that means that declining interest rates would augur well for valuations perspective across the market space, and the space will also tend to benefit. Inflation is pretty much benign with oil prices under control and food inflation also well within our reach and RBI's threshold levels. We think that this is also quite a bit of positive from a macro standpoint. Liquidity tightness was seen till March, and I think post March we have seen liquidity easing out. And obviously, the per capita income story of India, the rising income that is all pervasive, will broadly be $4,500 per capita by the year 2030. Why mid cap? I think the chief reason is that this is an under researched space. The large caps are very well researched, and basically, beyond the next 2-3 years, which is very well researched, you have to take your call as to how the long term growth story of these large caps play out. But in the mid and the small cap space, even the near term explicit period is not well researched. That creates a lot of opportunity to buy names which are very young in the cycle. So you have a larger universe, you have under research segment, there's high growth potential because you're dealing with the law of small numbers, right? And if the entire macro setup in terms of India's growth story looks good, then your individual stocks will make a lot of difference. And the FIs have also started increasing allocation to the mid and small cap. The turnaround that you have seen from April onwards, first the buying had been seen in the Nifty 50 stocks. This is always the case. First it is the Nifty 50, then it is the Nifty 50 next or Nifty next. Then it is going to be the mid cap, then it is going to the small cap. This is whole cycle just keeps on playing out again and again. So just reiterating the macro themes again, you're looking at declining rates, which is setting up the stage for a SMID revival, small and mid cap revival. You could jolly well assume 50 basis point cut at least this fiscal year, one tomorrow and maybe one again in September, October. But that is how we look at things. Valuations are supportive of this declining interest rates and inflation. Next. Consumption, obviously, demographics is a thing that has already been explored. And we have for all segments is the entire diamond shape of the demography that will see an uplift. The middle class will burgeon in the center. This is the long-term story of India. And obviously, you have to do your own stock picking. Now, if we define the large cap, mid cap, and the small cap space, as per SEBI's classification, top 100 companies are classified as large cap in terms of market cap. 101 to 250 is basically the mid cap, and 251 and beyond is the small cap. This is how the classification is done. We'll follow the same classification. So large cap is the top 100 is basically 90,000 and more is basically large cap. 28,000, 28,400 to 89,122 is the mid cap space, and everything below 28,378 crores, it is basically your small cap space. The classification is 63% of the entire market is large cap. In terms of capitalization, 19% is mid cap and 18% is small cap. We'll play within this 19 and 18% of the mid and small cap space in this fund. Next. So in terms of the average coverage of stocks in the large cap space, BSE 100 index is around 31 analysts on an average tracking these stocks. In the BSE 150 mid cap index, it's the 17 stocks, and BSE 250 small cap index, it's 8 stocks. So as I was alluding to the point, this is an under research segment which creates an opportunity. You have to be early in the cycle, run around the whole country, try to find these gems early in the cycle, and then hope for the fact that the market will give some credence to your stick picking, the thesis. If it comes true, then you'll create good opportunity in terms of market cap creation in these names which you have bought. Now, how growth potential of this mid cap space? I mean, you have seen that this is how the returns stack up for the BSE Sensex on a 1 year to a 20-year period. Average you would see is 15% compounding, 14.7% compounding on the BSE Sensex on a 20-year period. But if you were to see the 5-year period, and we think that mid and small cap should ideally be given a 3 to 5-year period. You buy when there's maximum pessimism around, and you give yourself or you give the fund manager at least a 5-year period. And in that period, broadly, you will outperform the markets. One needs to take a bit of, have a bit of patience, would broadly be having a slightly higher risk appetite. But if chosen properly, this whole portfolio delivers a much better return than the large cap space. On a 5-year period, 2.8 times is what the BSE Sensex has delivered, whereas the BSE mid cap TRI has delivered 4.1 times. The BSE small cap 100 TRI has delivered 5. So that is the main reason we think that mid and small caps in the last 5 years has delivered 33 to 38%. And because of a fascinating growth story of India, this space is going to be buzzing with activity. There's no doubt about it. It's not to generalize that everything is very cheap. It is not to generalize that everything is very expensive. And particularly this year is going to be all about stock picking. And so we think that this is a great opportunity in this space. FII ownership has also increased, and there has been sustained mutual fund flows even in the mid cap segment. Small cap, as on March 25, small cap mutual funds and mid cap mutual funds together constitute around 30% of the total equity flows, a significant jump from about 5%. The dual support from FIs and MS make the rally much more sustainable. I would give credence to the maturity of the retail investor also. In spite of the huge volatility, we have seen that the confidence and the faith in the Indian economy and the Indian stocks and the Indian markets have continued. Nothing has been let off. You could argue that you have old SIPs getting discontinued and new SIPs coming through. But that is how always the market has been. You'll have somebody throw in the towel and somebody pick up the ante on an ongoing basis. So I think that the financial literacy and the maturity of the retail investor, UHNI investor, has got proven this time around. The amount of correction that we have seen, and people have become more financially literate. And strengthening flows into the mid cap segment suggests that select opportunities in the mid cap and small cap space basically could outperform the larger markets, the large cap space in the medium term. You should give something like a medium term to what do we call a medium term? Less than 1 year is a short term, 1 to 3 years is medium term, and 3 years and above we classify as a long term. So this is a portfolio which is designed for a 3 years and above time horizon. Next. Yeah. Why now? I think valuations. This has been the main problem that has been talked about in terms of the expensiveness of this entire space. But we've got just one point to make out here is that the current P of the mid cap index is around 35. But if we were to remove skewness, That is to say that the components of the index where you have very large allocations, and these allocations would have very high valuation multiples. If you were to remove these outliers, then the multiple is around 31.6 times. The median PE multiple is around 28.3 times. And on a FY27 basis, we are valuing the mid cap index at around 25 times. That is to say, the EPS growth is going to be around 23, 24 times. Even this quarter, there was a lot of narrative that the mid and the small cap stocks as a whole is not going to do well. But suffice it to say, we have seen that the entire market broadly has given you around 15% growth for the fourth quarter, even though Nifty has grown just 1% in EPS terms over fiscal 25 over 24. And if for the fourth quarter, some numbers is that the mid cap space has grown more like 28, 29%, and the small cap space has grown 11%. So on a blended basis, this has grown at closer to around 14, 15%. So yes, in terms of headline, you could see that optically it looks quite expensive, but you have to adjust for skewness and you have to adjust for growth and the median P. It doesn't look that expensive. And so again, out here, if you were to ignore the expensive names in this space, you've got an opportunity as a whole. We for ourselves have always believed that in India's case, 3 price earnings growth does stick around. More than 3 PEG does not stick around for a very extended period of time. You really got to have some serious competitive advantage within you if valuations were to sustain at more than 3 PG sustainably for long periods of time. And this has got time tested. I mean, there's no doing away from that. So I think what matters is growth. And the whole effort is to get the growth right. And, if one gets the growth right and the valuation is within that 3 PEG range, between 1 and 3 PEG range, broadly, you don't have, or broadly, you'll have a large margin of safety from a next 5-year point of view. So that's basically our thesis out here. Yeah, next. In terms of earnings outlook, this is basically again the reiteration of the small cap space. Again, it's the P multiple is 30.9. If you were to adjust for skewness, it's 28.9. The median P has been around 28.7, and 27, according to us, is around 21.3. The EPS growth on a 27 basis around 24.5%, and on a PEG 27 basis, it's less than 1 time. So again, I would believe that even though reported currently optically, it depicts that it is more than 1 standard deviation away from the mean. But I think adjusted for growth, adjusted for the skewness, it doesn't look that bad, according to us. Yeah, next. Yeah, the investment philosophy and framework is concentrated portfolio by a handful of these stocks, 30, 35 names, not more than 10% in a particular stock to begin with. That discipline will remain. And I think low churn, buy and hold style of investing, aspire to build a portfolio of companies which can double their profits in 3 to 4 years. These companies generally would have ROCs more than cost of capital. We want these companies to achieve these ROCs through operating leverage as opposed to financial leverage. And broadly, we want to buy secular businesses in India's context. We would avoid cyclicals to a very large extent. And in order to avoid a lot of variability in income, we broadly would be buying into zero debt companies or very little leverage companies apart from the financials. Yeah, next. This is our equal framework, only one of its kind as far as we understand in India. We evaluate corporate governance of companies, and this has stood the test of time over more than a decade for us. And we have seen a lot of specific events play out in India's capital markets. This has stood the test of time. We've not had even a single blow up of companies, in spite of the fact that we have bought into mid and small caps. So, what is this framework? This is called the corporate governance evaluation framework, whereby we actually evaluate quality of management on 5 parameters, which is management integrity, management capability, investor communication, wealth distribution, and liquidity of the stocks. Next. And in terms of breaking down the management integrity, we again have parameters like promoters holding, FCCBs, you have what is the holding that is pledged, what is the promoter group salary, what is the auditor, what sort of interparty related transactions that you have, how much is the royalty and technical fees, etc. play out. So based on these parameters, we gauge the management integrity. The other four variables are independently given marks to. And what we have found out, some of these red flags have stood the test of time. We generally try to avoid these pitfalls. That if promoter holding pledge is more than 70%, it's a serious red flag for us. If there's debt restructuring more than once in the life of a company, it's a red flag for us. If there's no investor communication, they don't have analyst meet communications or analyst calls, investor meets, etc. We view that negatively. Debt is to equity more than 2.5 times. When there's diversification or there's misallocation of capital, we consider them as red flags. We try to avoid some of these names from our universe. Next. And I think this is our framework as to how we evaluate the corporate governance. We give them marks, and based on the base ranking, which is risk-free rate plus equity risk premium, highest ranking is to companies which achieve 85%. Then there is a tier down, which is 70 to 85% in terms of ranking, and 50 to 70% thereafter, and below 50%. Below 50% is totally avoided, and 85 to 70%, based on the number that we get in terms of the marks which each of these companies get, we take the haircut on the allocation that we want to give to these names. And this is basically across large caps, mid cap, and small cap. Yeah, next. Yeah. So, yeah, we have done well in terms of our stock performance. As I said, that we have more than 100 years of fund management experience. Mr. Karwa, who is our managing director, has been more than 3 decades. I I bring in around 3 decades of experience in public money management in equities. Sachin, my colleague, has another 25 years. Kashyap, another 15, 20 years. So all in all, we can evaluate managements quite well, and we understand what works in these markets. That is how some of the stock pickings in the previous past has worked for us. Yeah, next. So this is basically your entire objective of the fund, to achieve capital appreciation through select portfolios of stocks, around maximum number, around 35 odd names, all listed, BSE 500 standard benchmark, BSE 250 small cap will be the secondary benchmark. It is available in both your PMS and AIF format. I'll be the primary fund manager, and Kashyap would be my colleague as co-fund manager. And yeah, so Mr. Karwa is the managing director, and Mr. Kacholia is the co-managing director. These are the two founding members of MK Investment Managers, both stalwarts in their own rights. Mr. Kacholia has served on the board of SEBI, certain committees, CDSL, BOI. Mr. Karwa is a rank holder in the CA finals, more than 3 decades. He has built this business from scratch, quite a veteran in the equity research and capital markets. Yeah, next. Yeah, I have been 3 decades in capital markets. My previous stint was at Motilal Oswal Asset Management, where I headed the PMS and the AF division, which is the alternates division of Motilal Oswal. For 19 and a half years, we built the business from scratch there. Kashyap is my co-fund manager. He's a homegrown guy, and he has been a ranked BFSI analyst for a decade or more, and over the last 5 years, he's in the buy side. He independently runs a fund which is focused on the manufacturing team, and he's now my co-fund manager. Nagesh is a national sales head, uh, again quite a veteran in the money management in equities. He has had various positions in ASK Investment Managers, ENAM, previously ING. So again, quite a rich experience in terms of experience. So yeah, we have a 7-member investment and research team with a collective investment experience of more than 100 years. Thank you so much. I'll take a pause here and invite any questions, suggestions that you may have. Thank you.
So, friends, we open the floor for questions. Please, you can raise your hands or you can type out your questions in the questions box or the comments box. Okay, friends, so I see there are no questions. Once again, if there are any questions, please type it out. Or if uh, you guys feel, you can always reach out to us for questions. So Bharat from Reuters is asking, how do you view the markets in the near term, trade turbulence and risk of elevated US yields and foreign outflows on one side?
Yeah, so our base case is that the US dollar is going to depreciate given the internal problems and a whole lot of refinance coming up. So, in that sense, there'll be assets moving out of the US dollar. In that sense, the emerging markets stand to benefit. India is a part of the emerging market space. I think flows into India is likely to go up. Uh, Secondly, I think the near term markets would be range bound because two specific events. Uh, uh, First is the continuation of Operation Sindoor, whether it's going to happen or not happen, we don't know. And the second is basically 9th of July, which is your tariff reset, reciprocal tariffs. That is the deadline. And we are around a month away. So I think near term 25,000 on the upside looks difficult to get breached, and 22,000 on the lower side gets difficult to breach on the downside. And there's simple maths around this. I think FY26 uh, broadly at around 1150 or thereabouts as the EPS for Nifty 50, and FY27 more like 1325 or thereabouts. That on an average gives you around 1230 or 40. If you give it a 18p, which is the median P that India has seen over the last decade or so, broadly are at around 22,000. And on the upside, given the earnings growth trajectory, sustaining a 20p multiple and beyond on a fundamental basis looks difficult on a near-term basis, unless and until you want to give a 27 outlook, because 27 is still some time away. So I think an average of 26 and 27 is considered, and a 20p multiple that sets you around 25 or 1,000. So near-term breakout above 25,000 looks difficult. Near-term breakdown below 22,000 again looks difficult. Second half likely to be much better than the first half in terms of numbers, earnings, because you have a low base and macros are looking good. Earnings should accelerate towards the latter half of this year. You have a consumption boost coming up because of a tax break, income tax break that boosts consumption on the discretionary side. You have an eighth pay commission recommendation coming up in April 26, which again sets the stage for a boosted consumption on the discretionary side for government employees. So I think pendulum is likely to shift away from investment as a theme to consumption as a theme as we progress into the new financial year. So that's how we would look at the headline numbers in terms of market, but whole lot of opportunity in the mid and small caps.
And there's a question from Mohammed Harris. Is asking, what are the sectors you feel investors should focus now?
No, so I think as I said that I have become very bullish on consumption as a space. And please understand one thing: expansion of fiscal deficit is always good for growth. Shrinkage of fiscal deficit is not so good for growth. India has maintained the fiscal deficit discipline. 4.8% in fiscal 25, going down to 4.5% in fiscal 26, in spite of the fact that we have had Operation Sindoor. So I think post the pandemic, government spent a lot to save lives and livelihoods. That created a huge growth opportunity for investments as a theme. Government was lifting the ante in terms of investments. I think as we shrink our fiscal deficit, get back to normal post COVID, and now that you have a leeway being given on income in the hands of people of India through tax breaks, etc., this pendulum will shift away from investments. Government spent 10 lakh crores or 1 million crore rupees in fiscal 25 on capital capex. That's roughly 3% of GDP. I think 3% of GDP is a very good number. And I think because the nominal GDP growth is around 10%, this 10%, 10 lakh crores will become 11 lakh crores going into the next year, which is again a very decent number. But look at the valuations on some of these capital goods, etc. I understand there's definitive growth between now and the next 5, 6 years, but we got to value long dated order book positions in companies slightly on a long dated basis rather than near term very lofty valuation. So I'm extremely positive on consumption, BFSI, including insurance, pharmaceuticals because of India's right to win, GLP-1 opportunities coming through, which is semaglutide, both export and India. We'll figure it out how each of these components benefit in this space. IT, because valuations are very, very conducive, and capital market entities. These are platform companies where if the long-term trajectory on these names look pretty decent, then because these businesses are duopolies, very few players, the profit pool is going to be between these players. So platform companies in this space. So these are metals, etc. Because of dollar depreciation, will also stand to benefit. So these are some of the sectors, but suffice it to say, new emerging sectors like EMS, semiconductors, they will also be good sectors, but one has to take a call on the valuations per se.
And sir, apart from these sectors, I think the defense tech space, because in recent, war scenarios, we've seen a lot of, drone companies have actually inflicted damage to bigger aircrafts, and they are boosting consumption for aerospace sector. So, do you see some more coming in defense tech space as well?
See, I think the fillip or the boost that has come to the defense companies has been on account of Operation Sindoor. And I think emergency procurement of 40, 50,000 crores definitely gives a boost to the defense names. They have run up also. And a portion of these defense emergency procurement will come out of the total 10 lakh crores or 11 lakh crores worth of budgets that was assigned for the capex spend. This is my understanding. We'll see that how it unfolds. But yes, you are right that individual companies will make a difference. But please understand that narrative is a different thing, and fundamentals of companies supported by profits and loss profits translating into cash flows. That's the ultimate reality. So if a company is just very good on account of a narrative that the defense sector looks very promising, would need to get justified with order book translating into top line growth, earning EBITDA margins translating into PBT growth and PAT growth. Unless and until that gets fructified, everything else just stays a narrative. So yes, this is a very momentum-driven sector currently, full of froth, according to me. Very little to define in terms of justification of valuations. So we'll wait for better valuations to approach some of these companies. The space is extremely vast. You have tier one vendors, the PSUs, the top 3, 4 PSUs, and then you have a whole lot of tier two vendors supplying to that ecosystem. What needs to be watched out for is whether the allocation of defense on an ongoing basis moves up from the usual trajectory of allocation that we have been seen to using. because the geopolitics around us is somewhat more nuanced in these times and would warrant good attention. So yeah, this is one space which is broad based, but drone companies will have to report numbers or order books, which gives you some sort of a path to profitability on some of these names. Except for that, it's just narrative.
All right. Any more questions, friends? In case you don't have any questions now, you all can reach out to us eventually. So we have Abhinav Saha who has a question on given recent dollar movement, do you see a sustainable dollar down cycle on the way like we saw in 2002, 2007? If so, will it mean increased FPI flows?
Yeah, absolutely. I'm with you on this. I think the dollar is quite vulnerable, and you know we got to be on a very strong footing, according to me. Dollar, US, the Indian rupee is likely to find strength. That helps our cause on in imports, and that helps FDI flows. That helps emerging markets. I mean, look at it this way: spread between the US 10-year and Indian 10-year has shrunk to record lows of 1.6. If we have another 25 to 50 basis point cut on the 6th of this month, which is on Friday, you'll have the spreads even compress to closer to 1%. We have never had this sort of strength exhibited in terms of our interest rate. So yes, I would agree with you. The rupee is on a strengthening path. The US dollar is on a declining path. According to me, they will depreciate, and that benefits FDI and FI flows. FIs have, after a very long time, started to look at India quite favorably. And the chief reason for the last 1 2 years, which they have been selling, is primarily one of the reasons has been very weak Indian rupee. Indian rupee was overvalued. It sunk to 88, so now it's closer to 85 and a half. So it appears that on a balance of payments, if as long as oil is on a muted optical curve, then obviously we stand to benefit. So I would agree with that.
Okay. So I guess that's it for the questions. Thank you so much, Manish sir, for being with us on this webinar, and thank you, our friends from the media, for joining us. Uh,
Thank you, folks. Thanks for sparing your time. It was a great pleasure interacting with you all. Thanks.
thank you, everybody.
Thanks. Have a great day.